until 2014, when the Bank of England began to break away from the mainstream. And you'll now find an extremely important paper that if people haven't read it, I highly recommend they find it, called Money Creation in the Modern Economy. And it's written by the staff at the Bank of England. And it comes out and says the textbooks are wrong. Now, what the textbooks teach about how money is created is what Austrians I know are normally very critical of. They call fractional reserve banking. And I think you can actually probably get an Austrian demonstration tomorrow outside the Federal Reserve calling for the abolition of fractional reserve banking in the middle of all the Black Lives Matter demonstrations. Do you think I'd be right there, Simon?
Definitely. I mean, fractional reserve banking is, you know, the cardinal sin, the responsibility for all our problems in this community.
Yeah, well, I've got a little problem for you guys. It does not exist. It is a textbook model which is fundamentally false as to how money is created and how money is managed. And it's perpetrated by textbooks. It's believed to describe a model which the neoclassical economists think is quite a sensible system, and it's easy to teach, and they think it's really, you know, they've got a hunky-dory little tool they can show about money creation using the fractional reserve system. Austrians think it's fraud. They're both wrong. It doesn't damn well exist. It describes a system which does not exist. So the Austrians demonstrating against it, and the neoclassicals practicing, might as well be discussing how many angels can dance at the head of a pin as to how relevant they are to the real world.
Yeah, so one thing I've always told people is there is no fraction and there is no reserve. So
yeah, well, there is a reserve, but there is no fraction. And I think what is going on is people have been taught a textbook model that says if a depositor walks up to a bank and drops $100 into their deposit account, then the bank says, that's very good, I'll hang on to 10 of that and lend out 90. And that's what Austrians see as fraud. You're lending out money you haven't actually got. And then, so that person then goes to another bank and deposits the 90, and the bank hangs on to the 9, lends out 81, and et cetera, et cetera. So $100 in creates $1,000 worth of money. And that's what's seen as fraud by Austrians. It's seen as a sensible monetary system by neoclassicals. It doesn't work that way when you actually look at accounting. And this is bringing realism into the picture. If you look at a bank in terms of assets, liabilities, and equity, and that is fundamentally how you have to view any financial institution, then it's, if you have that person putting that $100 into a bank, that goes in as a liability to the bank because it's a deposit. So the liabilities rise by 100. The reserves go up by 100, which is an asset. So there's an increase in assets and liabilities, no change in the bank's equity. If you then say the bank lends out $90 of that, then how do they do that? If you say that their assets therefore fall by 90, that also means their liabilities have to fall by 90, or their equity has to fall by 90. Now, that can only happen if the person who takes out the loan actually takes it out in cash. So the only way the fractional reserve banking system works is if all loans are in cash. You decide to go and buy some nice little place in Mayfair. The bank said, that's a great idea. Here's a £5 million loan to go and do it. And you walk out of the bank with £5 million, 500, or is it 50,000 £100 notes in a wheelbarrow. No, you do not do that. What the bank does is they say, here's a $5 million loan, £5 million loan. They record a £5 million increase in their assets as the loan to you. They then record a £5 million increase in their liabilities to you, which is the deposit account. You then transfer that money across to the buyer. So banks create money by creating loans. And rather than needing reserves to do it, reserves are fundamentally irrelevant. Reserves are really there because if you get your loan from Barclays and the person whom you're buying the property off banks at Lloyd's, then Barclays has to transfer £5 million from its reserves to Barclays reserves. So reserves aren't there at all to enable lending. They're there to enable interbank transfers.
You said a bold statement there that we're highly likely to be moving into a depression. What does a depression mean? And what makes you say that we're going to move into a depression?
Largely, the depression is a collapse in monetary demand. And the collapse in monetary demand comes about because monetary demand consists of both the turnover of existing money plus newly created money created either by the credit system or by the government. And what caused the Great Depression was first of all, a boom in private debt in the 1920s, which wasn't as large as the bubble we've been through in the 1980s to 2010, but that credit fueled the roaring 20s. That then crashed in 1929, and you went from positive credit to negative credit, massively negative, about minus 10% of GDP. And with that credit going down, you also had a reduction in the money supply, and that was a self-amplifying system that drove us into the depths of the Great Depression. And we've basically replicated that same experience in 2008. We'd stopped it because, as well as private banks being able to create money, so can the government. And government money creation stepped in 2008, 2009 to balance the destruction of money by the private banking sector. And that then stabilized the system to some extent, but it left us with a huge overhang of private debt. And again, this is something which most people aren't conscious of because economic theory says private debt doesn't matter. So most economists don't even look at the level of private debt. But that's what caused the bubble. But now, that's what caused the bubble and the bust in the 20s and 30s, the bubble and the bust in the 80s, 90s, noughties, and through to 2010. And now we're on the precipice of another huge crash because of the impact of the coronavirus on our economies and the huge collapse in monetary demand coming out of that, and an increase in debt because people are borrowing money simply to remain able to continue operating during the shutdown. And when the crisis, if the crisis ever passes and the government supports are pulled away, then there could be a huge collapse in monetary demand, and we could go into well, we're already in a depression, but it could continue with a financial course after the virus is gone, if it ever is.
So do you have a model in terms of how long a depressive environment might last and what we need to be preparing for? Or is that very much a political conversation? It depends what the politicians do next.
No, it's something that can actually, the politicians can terminate it, or they can also cause it. But they can terminate it if they act quickly enough by government money creation. But it might be worth me sharing a screen here so I can show some data on this front, because it is always better to show these things in terms of data. This is the level, can you just see if you can see, I'll just...
I can see that now.
Okay. This is the level of private debt and credit in America for pretty much the duration of American capitalism, from the 1830s forward. And you can see that the level of private debt peaked at about 65% of GDP back in the mid-1930s, then at 145% roughly in the Great Depression, and 170% what we call the Great Recession. And so if you look at where we are now, we've got a high level of private debt, about 150% of GDP, than we had back at the peak of the Great Depression. Now, what I was saying beforehand is that credit drives the economy in ways that mainstream economics doesn't understand. And credit, I'm very fastidious here. Most people use the words debt and credit interchangeably. I use debt to describe the dollars we owe, and I use credit to describe the rate of change of the dollars we owe. So debt is the outstanding level of money that you owe to a bank, and credit is the rate of change of bank debt per year. And that credit is what creates money when it's being positive, what destroys money when it's negative. So what I'm showing down here in the blue line is negative credit. The credit, which is the rate of change of private debt, peaking at about, I'll just actually show the numbers here if I can. Let's hope this works. Let's see. 12% of GDP. Back at the peak of the boom in 1836. You go to 1930s, it's 9 and a bit percent of GDP, and come forward to here, it's 15% of GDP. The crisis itself was a period of massively negative credit. That's running at minus 8%, 8.5% of GDP, and its net credit is negative pretty much from 1930, halfway through 1937 through to 1943. Then it's negative from 1930 through to about 1937, 38. And then for us, in our crisis, it went negative from 2009 to 2011. Now, that is an insight on what causes Great Depressions, which most people don't have because they don't see the role of credit. We all knew about the Great Depression. We all lived through the Great Recession. I did not even know what this was over here until I plotted this data. And I went then and checked the data, and I found that it was what's called the crisis of 1837, which was regarded as the worst downturn in America's history when it first hit, and it may still be worse than the Great Depression. If you look at the length of time that with negative credit there versus the Great Depression or now, that's a forgotten crisis caused by negative credit. To show the UK data, I know you've got UK policies as well, as we discussed earlier. This is the UK's data. And the thing I find remarkable about the UK is that private debt never exceeded 73% of GDP, right from 1880 all the way through to 1982, when Margaret Thatcher was in power. And you then had this huge increase in private debt from 58% of GDP in 1982 through to 195% in 2009. Now that data is what I look at to say that's what causes a Great Depression, periods of massively negative credit. And that's been confirmed in a superb book I highly recommend to your readers by an ex-banker called Richard Vague. Richard ran two of America's major credit card companies. And the book is called The Brief History of Doom. And he's gone through 150 years of data and incredibly meticulous research into newspaper records and so on, explaining every major downturn in the last 150 years in the six major global economies. And every last one of them was a credit collapse. So this is strongly empirically supported information. It's not based on an ideology. It's based fundamentally on empirical data and saying, how do we understand what's happened? And every time you look at a Great Depression, it's negative credit that causes it. What I expect to have happen is more chaos, and particularly, unfortunately, governments going back into austerity again because they believe it's their debt that matters, not the private sector's debt. And that will actually amplify the tendency towards another Great Depression. Here, what I've done here with the data, this is the American data once more. I've broken it down into household and corporate debt. So the black line is corporate debt, the orange line is household debt. You can see the bubble that gave us the subprime bubble, well and truly in the data there. You can see that corporate debt is at the highest level it's been in the history of capitalism, except during the Great Depression. And household debt is at the highest level it's ever been. So that's the situation we're in right now. Now, what is likely to happen is an acceleration in that debt level because of the impact of the coronavirus. This is now showing commercial and industrial loans. This is a wonderful database maintained by the St. Louis branch of the Federal Reserve. And this is just the outstanding level of corporate industrial loans, all commercial banks. You can see the peak during the last crisis and the decline here. Here's the coronavirus. There's been an increase in private debt since the coronavirus began. I'm just trying to get it to start here, from 2.36 trillion to basically a $700 billion increase in a matter of a month. Now, the reason for that is obviously banks aren't going out saying, we've got these great investment opportunities we want to take advantage of. They're extending what line of credit they do have because otherwise they'd be unable to pay their bills. So we've got a huge increase in indebtedness at the same time as a plunge in the income earning capability of their main consumers, workers who are facing horrendous unemployment rates, Great Depression levels. So if we go into that situation and governments try to restrain their own spending to restrain their own debt level, they'll add to there'll be three factors all trying to save money at one time. The commercial company, corporates are trying to reduce their debt level, household sectors trying not to spend, the government trying to cut. Income will collapse. And income collapses will have a high level of debt at the same time. We'll get a blowout in the debt ratio, which is what happened back in the Great Depression. So I'm worried that what we'll actually do is the exact opposite of what we should do, and will make the crisis worse.
So it seems like a good summary is that we are in a level of debt we have never seen in the entire history of humanity. Dr. Steve Keen thinks that the governments will try and solve it with more debt. The reason for that is because the central banks and policymakers are dominated by a particular school of thought of economics. So we can really trace it back to economics, and the schools of thought and the policymakers seems to be the future of our destiny here. And we do have an ideal opportunity for a monetary reform. We've thrown everything because of this virus at the system. I guess people need to be preparing for the fact of what does one do if we enter a Great Depression? How do they protect themselves in such a scenario, and prepare themselves for a number of different eventualities of really rehypothecating the same system, or potentially entering into a new monetary reform, because now that whether that happens or not is certainly a political conversation. Would you add anything to that, and what would your final thoughts be that you'd like to leave the audience with?
Well, I think in some senses a parallel monetary system may be necessary to avoid the depth of the downturn. I'm a critic of Bitcoin because it's actually been used for hoarding rather than transactions. Bitcoin SV and a few of the other systems which are based on transactions, something like that might be necessary to avoid the worst of the downturn. So I have a certain sympathy for that. So long as we're not talking about hoarding, we're talking about spending. And everything I've seen in Bitcoin is focused upon the store of value function of money and not the means of payment version of money. And with not the sort of store of value we need, it's the means of payment. So a system which promotes means of payment, which is maybe a non-state system, maybe a good idea in this crisis, because I do expect the state systems, because they're led by bad economic theory, which is what this book up here is about, debunking economics, to make the wrong choices in a policy situation rather than the right ones.